Welcome to the weekly Titans of Industry interview. And as we're recording this, the Fed is about to raise rates for the second time in 1 year. And so what I wanted to do today is have a year-end review of the resource sector and create a potential outlook for 2017. So I created this roadmap that we're going to go through today with a lot of key metals that I want to feature in commodities to go over. And what will be beneficial for our listeners worldwide is to get into the mind of a man that has been at the top of his game for longer than I've been on this planet, most of us. And we're going to talk with Rick Rule today. Rick is a legend in the resource sector, owner of Sprott US. And, Rick, how are you today?
I'm fine. It's a pleasure to be with you. Thank you.
I am very excited to do this. First of all, I just want to ask you, you've been at this for so long. How much do you love what you do? I mean, you've been doing this for I don't know, like 4 decades now. Are you excited about opportunities that you're seeing today?
Yeah, I'm one of these really lucky guys who is eager to get to work in the morning and sometimes resents going home from work at night. If you define work as something that you don't like to do, that you do to provide sustenance, I've never worked a day in my life. I greatly enjoy the business. I greatly enjoy my friends here at Sprott, the clients. I'm in a really enviable position, frankly.
I heard Warren Buffett say something like, "I dance to work in the morning." So, quite similar. You're saying,
right?
I'm very happy to get you on the show, and obviously somebody who enjoys what he does so much just does it so well. I believe that's true in my heart of hearts. And on the screen as we're doing this, we're displaying charts of the top performing metals of 2016, and zinc has been the clear winner. Why is that in your opinion? What do you see in 2017 with prices rising and supply? It keeps shrinking. Even the stockpiles keep shrinking. This could be one for the record books. What's your conclusion?
Well, one for the record books takes a very short view. The truth is that, and people need to understand this before anything else in resources, bear markets are the authors of bull markets, and bull markets are the authors of bear markets. The cure for low prices are low prices, and the cure for high prices are high prices. Let me explain. It is frequent in natural resource-based businesses in bull markets to enjoy 50 or 60% operating margins. When that occurs, a couple things happen. One, supply increases because companies' cost of capital goes down at the same time that their retained earnings soar. And the management teams always confuse bull markets with brains. Concurrent with that, high commodity prices encourage users to substitute other materials for the high-priced material, and also to put in place fabrication techniques that minimize the use of the material. In other words, they conserve. First-year economics would teach us that when supply increases and demand falters, that prices fall apart, and that's, of course, what happens. But the converse is true, too. When prices of commodities are very low, over time, demand increases simply because the low price of the commodity increases the utility of that commodity to users, at the same time that the very low unit price of the commodity constrains supply. Now, it's important for your listeners to understand that there are 2 ways out of a commodity bear market. The most frequent is demand creation. In a decent global economy where a commodity is priced very low, think like natural gas was in the United States the last 5 years, the low unit price of the commodity itself is sufficient to, on a global basis, has been less than the cost of production. In other words, where you make the stuff for $1.10 a pound and you sell the stuff for 85 cents a pound, losing 25 cents a pound and trying to make it up on volume, you decapitalize the industry. You actually cannibalize and destroy productive capacity. And that's important. When you rebalance supply and demand by reducing capacity, by reducing supply, what happens is that when the price begins to increase, as it has recently in zinc, there's no supply response because the ability that the industry has to increase supply takes a lot of time, 5 or 6 years, and literally in some cases billions of dollars of capital. So if you look at the commodities that have responded well this year, zinc being one and met coal being another, what has happened is that the very low prices have constrained supply and increased demand. And you got precisely the response that you would suspect, or at least I would suspect, having lived through in my career 4 market cycles like the one we're in.
This is very interesting. And just to elaborate on this, zinc supply has been so constrained because major mines have shut down and stockpiles are going lower and lower. And is there a true replacement for zinc? I mean, most of it, 50% goes for coating and galvanizing. Is there, in China, the car industry is booming. It's the biggest in the world, and only a third of their cars are being coated. So they need to replace, millions of cars. Can they even find a replacement for zinc, or is the demand for zinc as the 4th most in demand metal in the world very, very stable? Because I know for at least the last decade, it's gone up 2% a year. That's a pretty stable and decent demand.
At today's prices for zinc, there's no incentive to substitute another material for it. There is probably substantial scope at higher zinc prices to look for more efficient anodizing and coating applications. But the truth is that dollar zinc, there's no particular incentive. It's so cheap relative to what it does that I don't think that you'd see any substantial substitution or conservation efforts taking place until the zinc price was 50 or 60% higher.
That's incredible.
I mean, the truth is, like platinum and palladium, zinc offers such utility to consumers, and it is such a small component of the finished price of the product that the demand for it in terms of the current market price is pretty inelastic, which is a different way of saying that there's a lot of price elasticity built into the commodity.
I understand. I on the chart that we're displaying right now, the second top performer for 2016 is iron, and what's going on with it? I'm also very excited about it, but for the first time in years, it's going up. It's going up big, and no one's talking about this for the last 39 days. At Wealth Research Group, we've been looking at this sector and making calls to the most undervalued companies with world-class projects. What do you make of this quiet bull market, and are you intrigued by that personally?
No, the iron market was in fact way, way, way oversold. So I think what we're seeing with the iron market is a technical rebound from deeply oversold levels. The truth is that between Brazil and Western Australia in the Pilbara, there is sufficient developed productive capacity to address any near-term supply-demand imbalance that we might see. The iron market is not one for the faint of heart. The truth is that the big iron producers on a global basis, the BHPs, the Rios, the Vales, people like that, unlike the zinc business, have plenty of surplus productive capacity that they can put into play very, very quickly. In terms of participating in the in the iron market versus a junior game, the long-term track record of juniors trying to break into the iron business is virtually unblemished by success. I'd stay away from that one as a speculator. Look towards it perhaps as an investor in the very long term.
And how about steel?
What's the nature of the question? You mean, do I expect higher steel prices?
Well, it's the second top performing metal of 2016. So my question is...
Yeah, that's simply from such a strongly oversold position. The truth is that there's plenty of surplus productive capacity in the steel business. You may see shortages in certain types of steel, but seeing a shortage overall in the steel market. You're plagued by over rather than under capacity in the first instance. In the second instance, from the point of view of speculators, the large vertically integrated steel companies have such a definable competitive advantage that speculative numbers in that business don't have much of a chance against incumbent producers. From a speculator's point of view, I like the zinc market a lot more than I like the iron or steel market.
Why is there such a surplus? Is it easier to mine it? Is it obviously it's less rare, but is the technology better?
Well, remember, going back to the original opening statement of this show, we talked about the fact that the cure for bear markets is bull markets, and the cure for bull markets is bear markets. The bull market that we had in the iron business and the steel business in the beginning part of the last decade, going really from 2000 to 2007, was so extraordinary. We developed productive capacity for iron in Brazil, in Western Australia, and in other markets too. Billions and billions and billions of dollars were spent developing deposits and putting in place shipping infrastructure at the same time that the steel industry, particularly in China, but also in India, Indonesia, Russia, and places like that, geared up. So we have substantial overcapacity that occurred as a consequence of the last bull market that really overhangs the market now that we're in bear market economic, or at least soft economic conditions worldwide.
Understood. By the way, I obviously read the book Think and Grow Rich by Napoleon Hill, and the quintessential billionaire that Napoleon Hill hung around with was Andrew Carnegie, who revolutionized the steel industry back in the day because of exactly what you said. The steel price was very high, and he said, no, you got it all wrong. If we lower the steel prices as manufacturers, we can use it for much more products. And he was able to cut it from 140 to about 7, and people thought he was nuts, but it revolutionized the entire construction business. So that's a very interesting story about the first steel billionaire. I want to switch gears over to cobalt and ask you this. This metal is not, we define it as a critical metal or more futuristic metal. It's up more than 30% this year. And it's also a very interesting metal with regards to future uses and what it goes into. What's your opinion on it? Are you bullish on it?
I am bullish. It's very difficult to play. Now, cobalt is a classic example of what you would call the Carnegie syndrome. The truth is that if you increased cobalt production, you would greatly increase demand. There are all kinds of fabrication applications for cobalt that aren't being pursued simply because the supply of cobalt is constrained, and economic cobalt, that is, cobalt that can be produced profitably at today's prices, are really politically constrained. All you actually have to know about cobalt supply today is Congo and Russia. And if you were to increase current supplies of cobalt, you would greatly increase current demand. This truly is a situation where if you build it, they will come. The challenge from a speculator's viewpoint is that speculators want something that doesn't exist, which is politically secure economic cobalt. The cobalt that comes from countries that most of your readers can pronounce or would be comfortable investing in is usually in the worst cost decile in the world. The most competitive producers of cobalt, aside from minor production by Inco at Sudbury, where it occurs as a byproduct of nickel production, would be Russia and Congo. And the truth is that those deposits have such enormous cost advantages over every other potential cobalt field in the world that being a speculator in the cobalt business is pretty dangerous.
Is it because it's geologically forming in Congo or in Russia, or is it just because they got a head start, back in when cobalt became more useful? Why is it so concentrated?
The discovered grades thus far at Norilsk and also, of course, in Katanga are very high relative to the rest of the world. And the productive infrastructure, the infrastructure for producing it, particularly because it produces a byproduct of nickel and copper, give these very large deposits like Kolwezi or Norilsk in Congo and Russia, respectively, enormous advantages. Now, about once every 10 years, there's what I call a mafic metals bull market. It might be cobalt, it might be chrome, it might be platinum and palladium. And when those markets occur, it's a wonderful opportunity for prospectors and geologists in Ontario and Quebec in Canada to talk about Canada's ultramafic sequences and look for nickel and copper using cobalt or chrome or platinum and palladium as the sort of stalking horse. But the truth is, if you're actually focused on economic cobalt, from a practical viewpoint, you are still stuck in Congo and Russia.
Got it. Let's switch topics to the energy sector. It looks like Trump's victory is having an impact on which resources will be more important going forward, at least for the next 4 to 8 years. And I'd like to know, am I correct in assuming that the energy sector is affected politically by Trump's victory, and with regards to uranium, coal, and maybe also not in the energy sector, but potash? What do you think of these three resources and commodities going forward?
Other than U.S. production, I actually don't think that Trump will have a tremendous impact. Certainly, if he develops a power base that will enable him to deal well with Congress, that remains to be seen. I think both the Republican and the Democratic establishments despise him. That he will make mining in the United States somewhat easier. I would suggest that the key beneficiary of that would be the U.S. coal business. If Trump is able to develop political footing, and by that I mean institutional political footing rather than footing among the people who voted for him, I would suspect that he would make the U.S. coal business a beneficiary of his largesse. He might also benefit the little bit of the U.S. uranium business that survives, but I wouldn't see him being particularly important in other metals mining businesses in the U.S. simply because they basically don't exist anymore. One would suspect, again, to the extent that his political influence is felt on the Department of Energy, Department of Interior, that the oil and gas business might be expected to benefit as well. But my suspicion is that some of the metals that you have suggested will do well irrespective of Trump, simply because of economics, simply because of arithmetic. Uranium would be a wonderful example. Uranium in the U.S. is about 16% of our baseload power. On a global basis, it's a little higher. The International Energy Agency and Cameco suggests it takes about $60 a pound to make uranium, all in. That includes the producer's cost of capital. So you make the stuff for $60 and you sell it for $20. You lose $40 a pound and try and make it up on volume. That doesn't work. At some point in time, the arithmetic kicks in, which means either the price of uranium goes up or the lights go out. Those would be your two choices. And my suspicion between those two choices is that the price of uranium will go up.
Is China pursuing a very aggressive uranium type power base for them? Because I understand that from my research, they are building power plants and are looking to create more nuclear-based electrical power.
The Chinese are. The Chinese have a very pragmatic viewpoint towards energy, and the Chinese have a well-demonstrated need to reduce particulate pollution, which means that they have to look for sources of energy that don't generate a lot of particulate pollution. Having said that, the Chinese are also building coal-fired plants. They're building every form of energy imaginable.
Sure.
They would seem to be the largest current proponents of solar energy, of nuclear energy,
Sure.
and ironically of coal. What's important to uranium, however, isn't China, it's Japan. The restart of the Japanese nuclear fleet will be the near-term determinant in the price of uranium. If the Japanese government is able to get political consensus in Japan to restart the 24 plants that have permits in to restart, you change immediately the supply-demand imbalance for uranium on a global basis. Chinese demand is a longer-term phenomenon.
Understood. What's your thought on potash?
I love the agricultural minerals business, but you need to look 3 or 4 or 5 years in the future. There is substantial overcapacity in the potash business worldwide. There are 3 or 4 primary producers: Russia and Kazakhstan, Belarus, and Canada. And the truth is that there is a pricing war going on between Belarus and the Russians punishing Belarus. And this needs to work itself through the market. Every producer in the world, other than the big 3, and in fact some of the production of the big 3, is uneconomic at current potash prices. And the truth is that potash and the various ag minerals are important on a global basis for us to keep the world population fed without using every scrap of arable land in the world. Ironically, the environmental community, they're so hard on the agricultural minerals input industry, ought to be cheering them on, because without this green revolution, without the ability, as an example, to allow plants to uptake nutrients more efficiently, which is one of the things that potash does, we would have to put hundreds of millions of additional acres of habitat into production. So, yes, I like the potash business, but I like it long term. I think it's going to be a place only for the very brave and for the very patient for the next 2 or 3 years.
Got it. I want to switch gears lastly to precious metals, and you know, with the Fed rate hike coming in just a few days, as it looks now, the screen is now showing the interesting pattern that gold and silver have taken since 1971. Every time the Fed has announced a second rate hike, there's been 3 major tightening of interest rates, and in the 3 instances, 1972, 73, 76, 79, and 04 to 06, it's been detrimental for the S&P 500 and explosive for gold and silver. And you know, the reason for S&P 500 being detrimental, I can understand. Warren Buffett has said it best. He said just that interest rates are like weights on asset prices. But the reason that precious metals historically rally, in my opinion at least, is because inflation is going up at the same time as interest rates. So the real interest rates, minus inflation, stay close to negative. Are you cautious right now on precious metals or bullish? The charts are amazing. Like after the second rate hike in 72, 76 to 79, and 04 to 06, gold outperforms the S&P 500 by such a wide margin. It's I don't know. It's very remarkable. We've had such a great run this year, but also a meaningful pullback. Are companies fundraising right now, or are they cashed up and ready to expand?
Well, you've asked a whole number of questions there.
I know.
My own suspicion is that the interplay between interest rates and gold varies from time to time. I'm enough older than you that I remember the gold bull market of the 1970s. And when people say that gold acts in contradiction or opposition to interest rates, they need to remember the 70s when the gold price went from $35 an ounce to $850 an ounce at the same time that the interest rate on the U.S. 10-year Treasury quintupled. As you point out, it's a function of real interest rates. If the nominal interest rate on the U.S. 10-year Treasury offers up a negative real yield, then gold should do very well, as it did then. If you begin to see competition for real yields from the U.S. 10-year Treasury, then gold will do poorly. I would point out to your listeners a few points. The first is that if you believe, as I do, that the most important determinant in the gold price is real U.S. interest rates on the 10-year Treasury, that the U.S. 10-year Treasury has been in a bull market since 1982, and at 230 basis points, 240 basis points, the U.S. 10-year Treasury yield could go lower, which means that the bond could go higher. I would suggest to you that the bull market that we've had is much closer to the end than to the beginning. And if you believe that gold trades contrary to the bond, then that means the gold bull market is much closer to the beginning than to the end. To support that thesis, I would suggest to you that although the CPI stated rate of inflation in the U.S. is 1.6%, which means at 240 basis points that the 10-year Treasury has an 80 basis point positive yield, my suggestion to you is that the U.S. stated rate of inflation at 1.6% is too low. I don't think the people who construct the CPI shop where I shop. And I believe that the destruction of the purchasing power of my dollars is greater than 1.6%. I would hold out as further evidence the fact that the CPI, allegedly a cost of living index, doesn't include taxation, which is unfortunately a very important part of my cost of living. So I would suggest to you that even at 240 basis points, the real interest rate on the U.S. 10-year Treasury is negative or close to negative. And finally, one more thing, if I may. It's important to note that currently gold and precious metals-related assets just in the United States account for less than 0.5% of aggregate investments and savings in the United States. That is, less than 0.5% of all the investment dollars in the United States are invested in gold or precious metals-related assets. At the top of the 1970s bull market, over 8% of total U.S. investable assets were in precious metals and precious metals-related equities. And over the last 3 decades, the market share of gold and precious metals-related investments to total investments in the United States has averaged about 1.5%. So I'm not arguing to you that gold is going to win the war against the U.S. 10-year Treasury or other investment instruments. I just think it's going to lose less badly. It's going to revert at least to mean, which would result in a tripling of demand for gold and gold-related investment assets in the largest single investment market in the world. That's what I think is going to happen to the gold price.
So obviously very, very bullish. Also, I wanted to ask you as a follow-up question to that. It's just mind-boggling that it's even that low. I mean, just not even as an investment, just as a usual part of your portfolio. I would say that every person in the world, be it saver or investor, should just have gold as part of his physical portfolio, at least at 4, 5, 6% of everything you have. Why own it in US dollars, or why own it in one single currency and not have a gold allocation? So, that historical mean of 1.5% is so low that even that is remarkable to me. Why do you think people just don't own it as part of their daily life, not even as a speculation?
Well, in many parts of the world, people do. If you look as an example in South Asia, Pakistan, India, Bangladesh, Sri Lanka, gold and silver, physical gold and silver, are a very important part of the normal savings matrix of people there, including the peasantry. What has happened, I think, in the West, at least since the 70s, is we have developed more confidence since the 1980s in the ability of central banks, politicians, and central bankers to run the economy. My own personal belief is that this is misfound confidence. And I agree with you, although I wouldn't want to prescribe for people what proportion of their net worth to hold in gold, silver, and various forms of precious metals. But I would suggest to you that the confidence that we have in the big thinkers of the world, the central bankers and the politicians, to organize our economy is misfounded confidence. And I would suggest to people that haven't done so that they establish at least a modest position in physical gold right now in case the politicians are wrong. You know, Ben Graham talked about markets by saying that in the very near term they're voting machines. And if you're comfortable with the way people vote, perhaps the near-term market looks intelligent to you. But he says in the longer term that markets are weighing machines, that they look at what things are worth. And my suggestion is that when you weigh gold relative to government debt, that gold will become a much more important asset class relative to bonds going forward.
Absolutely. Rick, this was definitely a great year for what Wealth Research Group we call Metallionaires, which is resource investors that are very astute to these cyclicalities and boom and bust cycles and just prepare for them emotionally and make rational decisions. For people who want to do business with Sprott, how would they contact you, get the first introduction, and just find out more about your services?
I would be delighted if they came to our website, first of all, which is www.sprottglobal.com. Hit the contact button, give us your email address, and we will send you our periodical, Sprott's Thoughts. I guarantee that your listeners will get their money's worth because it's absolutely free. Beyond that, we have a wide variety of products and services at Sprott. We manage about $11 billion. We administer $2 or $3 billion more, almost all of it involved in natural resources and precious metals. I think it's fair to say by now that we're probably the most important global brand in small cap mining and resource stocks worldwide. And we service well in excess of 150,000 investors now. We would look forward to any relationship that your subscribers felt was proper and important to them.
Sure. I personally have a U.S. brokerage account with Sprott, and it's like a boutique treatment over there. It's wonderful. I'd like to thank you for this year-end review, Rick, and we'll definitely touch base in 2017.
Thanks for the interview, and thanks for the business.
I have waited a long time to have a year-end review with one of the smartest men in resources, and the reason I regard Rick Rule as such is because he thinks about things that others never think about, and deals with market psychology and human emotions as well as number crunching. In this interview we covered many topics, and I want to make sure you know exactly what to take away from this. Rick is most bullish on zinc, the world's fourth most in-demand metal, and he says it's following a classic bull market pattern. Zinc's supply shortage is immense, and in 2017 it will reach a peak deficit as the demand keeps being stable and rising. Make sure you subscribe to Wealth Research Group, as we will be profiling our debut stock in the zinc sector on the 18th of December. And after 60 long days of due diligence, we're confident that this research is the best in the industry. Regarding gold and silver, Rick sees many more years of stable prices, and he sees increased demand for gold on the monetary aspect of it, and for silver's monetary aspect, he sees increased demand in Asia, as they cannot participate in the gold bull market in a meaningful way because of its high price relative to their income. Rick also is bullish on uranium because of Japan and the prospect that, as he says, if they reopen their power plants again, it's a big statement on the validity and the future of the uranium sector. Lastly, Rick is bullish on Cobalt and Potash, but he says that investors should be very mindful regarding the companies they choose to risk their funds in, because these industries are dominated by very centralized markets. Rick isn't bullish on iron ore and steel, and he believes that an oversupply still exists for those metals. If you want to become fully educated on zinc, uranium, and precious metals, as well as understanding the strategy the Wealth Research Group and top investors are implementing, visit our website and download our special reports to gain in financial knowledge and applicable advice going into 2017. Happy holidays, everyone.